Warren Buffett may not be a man of many words, but if there's one stern warning he's given investors in the past, it's that a low-cost index fund is the most sensible equity investment for the great majority of investors. It's true. Warren Buffett, the Oracle of Omaha, believes that most people are better off with low-cost investing vehicles that track a major index, such as ETFs that pay juicy dividends. They're part of the secret sauce that has made his portfolio so stellar over the years. When it comes to ETFs that meet all criteria, JEPI and SCHD are unrivaled. However, in a showdown between two kings, only one can reign supreme. Today, we'll compare both funds across various investment metrics to determine the superior performer. We'll examine their historical and current performance, their return strategies, stats, and everything in between, in a head-to-head analysis to see who has a better expense ratio, dividend yield, risk management, and so much more. But that's only the tip of the iceberg. I'm also going to give you a side-by-side long-term projection based on a $100,000 one-time investment to determine which ETF provides better value over time. Spoiler alert, both have the potential to make you a millionaire, but one of them can double the return and weather the storm under any economic downturn. Right off the bat, there's a reason why both JEPI and SCHD are two of the most popular ETFs on the market. For years, they have garnered the attention of top investors like Warren Buffett for their amazing strengths and juicy features. Take, for instance, the Schwab US Dividend Equity ETF, or SCHD for short. It's the third largest dividend-focused ETF in the world. And JEPI is no slouch either. In fact, one might say it's been doing even better in recent history. With an accumulation of over $26 billion in assets under management accumulated in its first 3 years of inception, JEPI is one of the fastest growing ETFs of all time. And guess what? At that same time frame, JEPI has averaged about a 9% yield, with a lower volatility than the S&P 500. So you see, both of these ETFs are doing quite well. However, make no mistake, each comes with different strategies and holdings. First, let's do some background checks on these ETFs, starting with the JP Morgan Equity Premium Income ETF, or JEPI. This is an actively managed ETF designed to deliver comparable returns to the S&P 500 index while reducing volatility and offering monthly income. Wondering how? Well, it's kind of genius. To achieve this dual objective, JEPI invests in value stocks with attractive risk-return profiles and utilizes equity-linked notes, or ELNs, structured for covered call strategies. And as amazing as that sounds, there's more to where that came from. JEPI investors receive dividends every month. With an attractive yield of 8.13%, no other asset class truly comes close. Additionally, JEPI aims to mirror approximately 85% of the S&P 500 index returns while maintaining significantly lower volatility of only 35%, a goal it has achieved thus far. And speaking of low volatility, this might interest you. Remember the 2022 market downturn when stocks and bonds both declined? JEPI's combination of active management and low volatility has the potential to outperform passive management strategies. We can go on and on about JEPI's pros, but before you think it's a no-brainer pick for you, you might want to watch until the end to see which ETF works best for you, including the one that will make you almost $4.5 million richer from dividends alone. For now, however, let's talk about our second ETF, which is none other than the Schwab US Dividend Equity ETF, known as SCHD. And yeah, it's kind of a different ballgame. Instead of JEPI's two-pronged strategy, SCHD's main focus is on dividend-paying stocks, making it an attractive option for investors seeking regular income along with potential capital appreciation. SCHD is an ETF offered by Charles Schwab, aiming to mirror the investment outcomes of the Dow Jones US Dividend 100 Index. It's a benchmark gauging the performance of high dividend yielding stocks in the US market. And with an emphasis on quality and sustainability, the dividend stocks are selected based on their financial health, minimum dividend yield, history of consistently paying dividends, and a few other factors. One thing I love about this ETF in particular is its performance. When you think of some of the best out there in this category, and judging from a proven long term perspective, given that JEPI launched in 2020, you might be thinking about VOO, right? Well, it's no surprise. VOO is made up of 500 of the best firms in the US, and on paper, it should perform better. However, that is not the case. What if we told you that SCHD not only goes toe to toe with it, but also knocks it down? Observing this 10-year chart, VOO has yielded a return of 220%, while SCHD has generated 201%, indicating a closer performance comparison over the past decade than most expect. But here's where things get really interesting. Here's another chart. As you can see, despite SCHD's declining performance compared to VOO in 2023, it still outperformed its rival in the preceding 36 months or so. But if you're still feeling uneasy about SCHD's recent performance, take a look at its sector breakdown for a second. Considering that the majority of its primary sectors were affected by the inflation and recession of 2023, it's understandable why SCHD underperformed. Had it allocated more to technology, similar to VOO, its performance would have likely been stronger, although it's probably worth mentioning that JEPI tends to look into tech companies. Regardless, with 2024 showing signs of improvement, you can expect SCHD to experience another surge in performance. And guess what? SCHD's performance history has been marked by not only capital appreciation, but also by the income generated through its dividends. During periods of market instability, this dual focus can be especially attractive, as dividend income can offer a cushion against market declines. Plus, the ETF's fees are competitive, reflecting Schwab's dedication to providing cost-effective investment options. So you see, both JEPI and SCHD offer a myriad of benefits to investors. On one hand, JEPI focuses on generating income for investors, employing a strategy of selling covered calls on stocks within the S&P 500 index. This approach allows for consistent income, especially during market downturns, making it appealing for those seeking steady returns. Additionally, JEPI's active management adapts to market conditions, potentially mitigating risks. But on the other hand, SCHD is designed to provide exposure to high dividend yielding U.S. equities. It targets companies with a history of consistent dividend payments, emphasizing stability in income generation. SCHD's passive approach tracks a dividend-weighted index, offering investors a straightforward way to invest in dividend-paying stocks while maintaining a diversified portfolio. However, you might want to hold on tight because, in the end, you'll find out which of these ETFs offers the most value to your Benjamins in the long run. But back to their differences. JEPI's active management and covered call strategy make it more suitable for investors seeking income generation through options trading. Its focus on capital preservation and consistent income streams may appeal to risk-averse investors or those nearing retirement. Personally, I think the fact that JEPI is actively managed also works in its favor. Many covered call funds, like QYLD, employ a straightforward index as their underlying asset and apply a static option writing strategy on top of it. There's nothing wrong with that, but JEPI offers a more dynamic approach to security selection. The active approach allows the managers to maintain the overall low volatility style of the portfolio, but tilted in a way that is optimized for the current environment. JEPI also has a turnover rate of about 200% annually, so there is a fair amount of trading going on. Alas, JEPI's active management could lead to higher expenses and lower tax efficiency compared to SCHD. In fact, the former has an expense ratio of 0.35% compared to the latter's 0.06%. But while it lags behind here, the ratio is still very reasonable, considering it's an actively managed equity portfolio incorporating a covered call strategy. On the other hand, SCHD's passive approach and focus on dividend-paying stocks make it a more suitable option for long-term investors seeking steady income and potential capital appreciation. Its low expense ratio and tax efficiency are attractive features, particularly for those seeking a hands-off investment approach. However, it's not without limitations. SCHD's performance may be more susceptible to the risk of market fluctuations compared to JEPI, given its passive management style and exposure to sectors like oil and gas. Nonetheless, which of these ETFs is better on paper? If you're enthusiastic about technology and comfortable with some risk during interest rate hikes, JEPI might be the right choice for you. However, if you prefer stability and are less affected by interest rate fluctuations, SCHD, with its emphasis on industrial firms, might be a better fit. Keep in mind, though, that industries can be affected by market shifts and oil price fluctuations, so the decision is yours. Consider the strategies employed by these two ETFs. They each have their own distinct approaches to generating returns, despite sharing the goal of delivering investment gains. The JEPI game plan is about making money for investors, particularly during challenging market conditions like those seen in 2022. It offers stability as it is actively managed, with a team selecting investments expected to perform well, unlike some other funds that may fluctuate more, such as SCHD. In short, JEPI simply plays it smarter by adjusting its picks based on what's happening in the market. But is it going to make you a millionaire? Especially when compared to SCHD in the long run, though? Find out soon enough. Over the last 3 years, SCHD achieved a return of 32.26%, outperforming JEPI slightly. JEPI has seen a share price appreciation of 14.54% since its inception, averaging approximately 4.63% annually. Currently, SCHD offers a dividend yield of 3.34%. For JEPI, however, there's a juicy dividend yield of 7.2% and an average dividend growth rate of 7%. JEPI prioritizes steady income via dividends, exhibiting less volatility compared to SCHD, which offers higher growth potential, albeit with greater market fluctuations. And this brings us to the expense ratio yet again. As mentioned earlier, JEPI and SCHD differ in their expense ratios, which can have significant implications for investors in the long run. At the moment, JEPI's expense ratio is relatively higher at 0.35%, compared to SCHD's lower expense ratio of 0.06%. But while both of these percentages seem small, they can have substantial impact on investment returns over time. A lower expense ratio, such as SCHD's, means that investors retain a larger portion of their investment returns. With less money deducted from the investment for fund management, more of the investment's growth potential is preserved. Over the long term, even seemingly minor differences in expense ratios can compound, leading to substantial differences in the final investment value. For example, if two investors each invest $100,000 in JEPI and SCHD respectively, the investor in SCHD would benefit from the lower expense ratio. Over time, the lower fees associated with SCHD would result in a larger investment portfolio compared to JEPI. This is because a smaller portion of the investment returns is eroded by fees, allowing more capital to remain invested and grow over time. Additionally, SCHD's lower expense ratio contributes to its overall cost effectiveness as an investment option. Lower expenses means that investors can allocate more of their capital to productive investments rather than paying those fees. This can lead to enhanced long-term returns and improved portfolio performance, making SCHD an attractive choice for investors looking to maximize potential while minimizing costs. Therefore, the lower expense ratio of SCHD presents a compelling advantage for investors seeking to optimize their investment outcomes over the long term. But hey, while SCHD may have lower expense ratios compared to JEPI, the latter redeems itself with its historically higher dividend yield. Check this out. The dividend yield is a crucial metric for income-seeking investors, as it represents the annual dividend income received relative to the investment's price. And as you can see, JEPI boasts a significantly higher dividend yield of 7.28%, compared to SCHD's yield of around 3.33% for the trailing 12 months. This higher dividend yield indicates that JEPI provides a more substantial stream of income to investors relative to its share price. For investors prioritizing regular income from their investments, JEPI's higher dividend yield may make it a more attractive option despite its higher expense ratio. And let's not forget the fact that JEPI's focus on income generation through covered call strategies may contribute to the ETF having better offerings in the future. You see, covered calls involve selling call options on underlying stocks in the portfolio, then generating income from the premiums received. This strategy can enhance the overall yield of the ETF, making it appealing to income-oriented investors. Furthermore, JEPI's dividend yield may also reflect the quality and stability of the underlying dividend-paying stocks in its portfolio. JP Morgan's active management approach may enable it to select dividend-paying companies with strong fundamentals and consistent dividend histories, contributing to the higher yield. For investors seeking steady income and willing to tolerate a higher expense ratio, JEPI's superior dividend yield presents an attractive opportunity. The higher income potential from dividends can offset the impact of the higher expenses, providing investors with a reliable source of income over the long term. So therefore, while SCHD may have its advantages, JEPI's higher dividend yield offers a compelling reason for income-focused investors to consider it as a part of their investment strategy. So before we show you a side-by-side comparison of a $100,000 investment in both ETFs and see which one comes out on top, let's discuss the final component worth dissecting: risk profiles. While every investment comes with risks, which of these is relatively safer? Right off the bat, both of these ETFs offer relatively safe investment options within the ETF landscape. SCHD focuses on the dividend-paying stocks of established companies, which typically exhibit lower volatility due to their stable financial performance and consistent dividend payouts. This dividend-focused strategy provides investors with a reliable source of income and helps mitigate the risks associated with market fluctuations. Similarly, JEPI aims to generate income for investors through a combination of dividend payments and options trading, particularly covered calls. While options trading introduces a layer of complexity, JEPI's strategy is designed to provide steady income, even in volatile market conditions. By actively managing its portfolio and utilizing covered calls, JEPI seeks to minimize downside risk and preserve capital while still offering attractive returns to investors. Finally, the fact that both of their investments are spread across a wide range of stocks and sectors makes it all the better. Make no mistake, diversification helps reduce the impact of individual stock or sector downturns on the overall portfolio, enhancing stability and lowering overall risk. So overall, both ETFs are relatively stable in the region. They offer safety and stability through their dividend-focused investment strategies, diversified portfolios, and active management approaches. But does that mean they offer the same return? Not at all. There's quite a difference. Here's the side-by-side comparison of how your initial investment of $100,000 will work over the next 30 years in both ETFs. Starting with SCHD, if you invest $100,000 initially, it's projected to grow to almost $111,000 after the first year. Over the next 10 years, it's expected to triple to around $208,000. In 20 years, your investment could reach about $1,090,000 with annual dividends of approximately $61,000. Impressed? Just wait until we get to the good part. In 30 years, your initial investment of $100,000 could reach nearly $4.7 million, with an annual dividend yield of $362,480, or approximately $30,210 every month. So it's quite amazing to see that over the next 30 years, this ETF has the potential to increase your initial investment by nearly $4.6 million, with $2.3 million from stock growth and $2.2 million from reinvested dividends. But while that's undoubtedly impressive, is it better than JEPI? Let's crunch the numbers and find out together. Now, compare it with JEPI. Your $100,000 after the first year is projected to reach $109,000. After 10 years, it's projected to reach around $264,000. In 20 years, your initial investment will have grown to approximately $950,000, a bit less compared to SCHD. but that's where the high dividend and solid growth take charge. In 30 years, your initial investment has the potential to surpass $5.3 million, paying an annual dividend of around $816,000, which roughly translates to $68,000 per month. Curious to see how it all stacks up? Over 30 years, this ETF has the potential to add approximately $5.2 million to your initial investment, with around $860,000 from stock growth and $4.3 million from reinvested dividends. In essence, while SCHD demonstrates consistent growth potential and impressive dividend payments over a 30-year horizon, JEPI emerges as a preferred choice due to its robust performance and compelling dividend.